Hey guys, Sharwan here and welcome back to my YouTube channel Ind AS by Sharwan. So in the earlier video we have discussed about the classification of the financial asset or the financial liability. So we have seen like you have to classify your financial asset or liability into amortized cost, fair value through other comprehensive income and fair value through profit or loss. So that was the classification, like whenever you identify some kind of a financial asset or liability, you have to classify it into that three category. So now we will discuss about the accounting, or we can say like measurement of financial instruments. So how you have to measure your financial instrument. So you have classified your financial asset into amortized cost. Now what to do? What exactly is the process to record those kind of a thing into your books of account? How will you do it? So now those measurement is divided into two segments. First one is initial recognition and second one is the subsequent recognition. So initial recognition means like you first recognize your financial asset or liability into your books of account. So how or at what amount you have to recognize it into your books of account. And subsequent recognition means whenever you first recognize it into your books of account as per whatever I will tell you about the initial recognition, and then at every reporting period how will you how will you readjust or how will you recalculate the figure of those financial asset or liability so that the requirement of this standard can be fulfilled. So now paragraph number 5.1.1 talk about the initial measurement. So it says like, except for trade receivable within the scope of paragraph 5.1.3, at initial recognition an entity shall measure a financial asset or financial liability at its fair value. So remember that you have to recognize a financial asset or financial liability at its fair value, plus or minus. So you have to first calculate the fair value and then plus or minus in case of financial asset or financial liability not at fair value through profit or loss, transaction costs that are directly attributable to the acquisition or issue of financial asset or financial liability. So first you have to calculate the fair value and then add or minus the transaction costs that are directly attributable to the acquisition or issue of financial asset or financial liability. But you don't need to add or minus the transaction cost in case of financial asset or liability which is not at fair value through profit or loss. So when your financial asset or liability is at fair value through profit or loss, then transaction cost will not be added or deducted from the fair value. But if your financial asset or liability is at amortized cost or fair value through other comprehensive income, then add or minus the transaction costs that are directly attributable to the acquisition or issue of the financial asset or financial liability. Now to explain this provision, there is another application guide which is like appendix B of this standard, which will give you another exactly how to deal with those kind of a requirement, like how to apply those requirement into practical situation. So paragraph number B5.1.1 says that the fair value of a financial instrument at initial recognition is normally the transaction price. So whatever will be the transaction price, usually that is the fair value. So obviously when you do some acquisition or when you do transact some kind of a financial instrument with other entity, then whatever will be the transaction price will be the fair value at most of the cases. However, if part of the consideration given or received is for something other than the financial instrument, an entity shall measure the financial value of the financial instrument. So if the part of the consideration given or received is for something other than the financial instrument, so for that an entity shall measure the fair value of the financial instrument. So like for example, the fair value of a long-term loans or receivable that carry no interest can be measured at the present value of all future receipt discounted using the prevailing market rate of interest for a similar instrument. So like you have given the loan to some person without charging any interest, so obviously that is not the fair value of those loan. So you have to calculate the fair value of those loan by discounting at the prevailing rate of interest that loan repayment or those kind of a thing. So that's how you have to calculate fair value. Paragraph number B 5.1.2 and says that if an entity originates a loan that bears an off-market interest rate, for example 5% when the market rate for similar loan is 8%, and receive an upfront fees as compensation, the entity recognizes the loan at its fair value, that is net of the fee it received. So when you receive also upfront fees as a compensation for the differential interest rate, like in this example like 5% you are charging but the market rate is 8%, so instead of charging the 3% you are receiving the upfront fees. So you have to now calculate the fair value, which is net of fee it receives. So that's how we have to now calculate the fair value. So now you have seen that you have to calculate the fair value at the initial measurement. So like you have to measure a financial asset or financial liability at the fair value. So what will happen difference between the fair value and the transaction value? So suppose you give the loan to someone and the loan amount is 1 lakh and the fair value of that loan is maybe the 90,000. So now what will be the difference between the 1 lakh and 90,000? How will you deal it? So paragraph number 5.1.1a says that, however, if the fair value of a financial asset or financial liability at initial recognition differs from the transaction price, an entity shall apply paragraph number B5.1.2a. So it clearly says that if there is a difference between the fair value and the transaction value, then you have to apply the principle which is given in paragraph number B5.1.2a. B5.1.2a says that the best evidence of the fair value of a financial instrument at initial recognition is normally the transaction price. Obviously, the transaction price is basically the fair value of the financial instrument in most of the cases. If an entity determines that the fair value at initial recognition differs from the transaction price as mentioned in paragraph 5.1.1a, the entity shall account for that instrument at that date as follows. So now that is the principle, like if there is a difference between the fair value and the transaction price, then how will you account for those difference? So first point, at the measurement required by paragraph number 5.1.1, if that fair value is evidenced by quoted price in an active market for an identical asset or liability, that is level 1 input, or based on a valuation technique that uses only data from observable market, an entity shall recognize the difference between the fair value at initial recognition and the transaction price as a gain or loss. So in the two cases, the difference between the fair value and the initial recognition, the fair value at the initial recognition and the transaction price will be charged in the profit or loss account. What is those two cases in which you have to do it? First one, like you have the fair value is evidence by a quoted price in an active market for an identical asset or liability. So you have the active market from which you can get the idea of the quoted price, or based on the valuation technique that uses only data from observable market. So when you have those two kind of a data, then the difference between fair value at the initial recognition and the transaction price will be charged to profit and loss as a gain or loss. And second situation, in all other cases at measurement required by paragraph 5.1.1, adjusted to defer the difference between the fair value at initial recognition and the transaction price. So now you can see when there will be difference between the fair value at the initial measurement and the transaction price, then there is a two type of a situation. So if you have the active market from which you can get the quoted price, or you have the valuation technique which observe the data from the valuable sources, then the difference between the transaction price and the fair value at the initial measurement shall be charged to the profit or loss. If you don't have such kind of a data, then you have to defer the gain or loss, and we will see it by way of example like how to defer it. Also paragraph number 5.1.3 talk about the trade receivable. Despite the requirement in paragraph number 5.1.1, at initial recognition an entity shall measure the trade receivable at their transaction price. If the trade receivable do not contain a significant financing component in accordance with Ind AS 115. So paragraph number 5.1.1 says that you have to calculate the fair value at the initial measurement. But paragraph number 5.1.3 also says you that in case of a trade receivable, you don't need to calculate the fair value of the trade receivable. The transaction price will be the fair value in every situation except what is mentioned like finance component as per Ind AS 115. So that I think that thing will not be applicable in most of you guys. So therefore, in case of a trade receivable, don't calculate the fair value. The transaction price will be the fair value as required by paragraph number 5.1.3. So now you have seen that you have to calculate the fair value at the initial measurement of the financial asset or the financial liability. Now you have to calculate the fair value. So that is the initial measurement when you first recognize the financial asset or financial liability into your balance sheet. So now what about the subsequent measurement? Suppose you enter into a transaction and which is your financial asset or liability as on 1st October 2017. And now your balance sheet date is 31st March 2018. So at the transaction date, which is 1st October 2017, you have to calculate the fair value of financial asset or liability. So now what about the subsequent measurement, or what about the accounting treatment on 31st March 2018 when you finalize your books of account? So now the accounting treatment of the financial asset or liability will be depend upon its classification. So you know that you have the three classification for the financial asset, which is amortized cost, fair value through other comprehensive income, and fair value through profit or loss. And in case of a financial liability, amortized cost or fair value through profit or loss account. So now the accounting treatment will be depend upon different type of a category. So for first type of category, amortized cost, the accounting treatment is like the present value of the cash flow. So let me just explain you the accounting treatment of amortized cost and what exactly is the amortized cost by way of example, because you will understand the amortized cost and the effective interest method only by way of example. And if you want to also check out the definition, so a definition is also given in appendix A of the Ind AS 109. But to fully understand the concept of amortized cost, you have to first check out the example, then only you can understand the topic. So now as you can see into your computer screen right now, so example number 1 of this document tell you about the amortized cost, how to calculate the amortized cost and how to account for into a books of account. So example is like this: as a part of a staff welfare measure, Y Company Limited has contracted to lend to its employees sum of money at 5% rate of interest. The amount lent are to be repaid along with the interest in 5 equal installments. The market rate of interest is 10% per annum for comparable loan. Y lent 16 lakh to its employee on 1st January 2001. Following the principle of recognition and measurement as laid down in Ind AS 109, you are required to calculate the entries. You are required to record the entries for the year ended 31st December 2001 for the transaction and also compute the value of loan initially to be recognized and amortized cost for all subsequent years. For the purpose of loan calculation, following discount factor and at interest rate of 10% may be adopted. So here is the discounting factor, present value factor for the 5 period, which is at the rate of 10%. So in this loan, as you can see, like 5% the company is giving the 5% interest rate loan to its employee, but in actual the rate of interest or the market rate of interest is 10%. So you can now imagine that that is not the fair value. So 16 lakh is not the fair value, as we have seen into our while we have seen that you have to first calculate the fair value. So as you can see that at initial recognition you have to calculate the fair value. And we have also seen it into our practical guide, which is right now into page number 105. Like the fair value of the financial instrument at initial recognition is normally the transaction price. However, if part of the consideration given or received is for something other than the financial instrument, an entity shall measure the financial value of the financial instrument. For example, the fair value of long-term loans and receivables that carry no interest can be measured at the present value of all future receipts discounted using the prevailing market rate. So now you have given the loan at 5%, but the prevailing market interest rate loan is 10%. So it means that you have to discount the future cash flows at the rate of 10% to calculate the fair value. So let me just show you the answer of this example. So like this. First of all, calculation of initial recognition amount of loan to its employee. So the future cash flow is like this: principal and interest component at the rate of 5%. So in the terms of the loan agreement, the loan is repayable in 5 equal installments. Like you can see, you are required to calculate 5 equal installments. So it means that every single installment is of 3,20,000 rupees, and when we have calculated the interest at the rate of 5%, then 80,000 will be the interest component for first year, and then 64, 48, 32 and 16. So this is the actual principal and this is the actual interest at the rate of 5%. Now the total will be like 3,84,000, this much, which is adding those principal and interest. So that is the future cash flows which you have received or you will receive in every single year. Now discount those cash flow at the rate of 10% so that it can be fair value can be calculated. So 4 lakh multiply 0.909, which is the discounting factor of 10%, you will get 3,63,600, and when you will add all those, then 14,06,272 is the fair value. So remember that is the fair value which you will calculate by way of discounting future cash flow at the rate of 10%, which is the prevailing market rate of interest. So what about the 16 lakh minus 14,06,272? So 16 lakh is the transaction value, like this 16 lakh, but fair value is 14,06,272. So the difference between the transaction value and the fair value will be amortized, because we have also seen it in our case, like you will have to amortize and defer the difference between the transaction value and the fair value if you don't have any evidence by quoted prices and you don't have the valuation technique. So in our example, we will defer it, the difference between 16 lakh and 14 lakh 6,272. So now here's the table and the calculation of amortized cost. So this is how the amortized cost will be calculated. So for the year end one, 14 lakh 6,272 is the initial fair value, and then add interest at the rate of 10% on this amount. So this will be 1,40,627, and then repayment include the principal and interest. So we have seen, like, if this one 40 lakhs, 3,84,000, 3,68,000. So this is the principal and interest component which the employee will pay to the organization, and then that is the amortized cost. So how will you calculate the amortized cost? The fair value plus interest at the rate of 10%, which is the fair market rate of interest, and then minus the repayment, and you will calculate the amortized cost. And for the next year, there will be opening balance, and then add another 10% minus principal repayment plus interest repayment, then you will calculate the amortized cost for the second year. And then again this one, add 10% minus repayment, you will calculate. So this is how the table will work. And in the next final year, 3,05,000 will be like here, opening, add 10% minus repayment, then the loan will be like finished here. So this is the amortized cost, and this amount will be the amount which you will reflected into your balance sheet for the year ended 1. In the first year, this amount will be your amount of loan into your balance sheet, and the next year this one, third year this one, fourth year this one, and fifth year nil. So this is how your accounting entry will be done. Like in the first year you have give the staff loan of 16 lakh, then staff loan account debit by 16 lakh to bank because you have actually give 16 lakh, and then the difference, like that amount, that should be the the initial recognition amount. So the difference between the 16 lakh and this amount will be transferred to like prepaid staff cost account and will be credited by the staff loan. So when you will 16 lakh minus 1,93,728, so this will bring like 14,06,272. So 14,06,272 will be your initial recognition amount into your books of account. So this is how it's gonna work. And then staff loan account debit to interest expense. So this is the interest expense which is required to be make entry in every single year, like 1,40,627. 1,40,627 is the interest component, and then you will have to make another entry which is like bank account debit to staff loan. Bank account debit to staff loan, bank account will be debit by 4 lakh and staff loan will obviously be credited by 4 lakh. So this is the initial amount, and then you are adding the interest, and then you are subtracting the repayment. So obviously this amount will be reflected into your balance sheet for the year end, first year end, and then this will again be opening balance, then add another 10%, then deduct repayment, then you will have this much amount into a balance sheet. So this amount will be always be reflected into a balance sheet for every single year, because when you will make those two entry, then your loan will be reflected with this amount which is the initial recognition amount, and then you will do like interest, staff loan account debit to interest expense. So this is the interest at the rate 10%, and when you will another make entry of bank account debit to staff loan, so this is the repayment amount. So you will obviously be left with this amount in every single year. And remember this prepaid staff cost to staff loan. So this is the difference between the 16 lakh and the initial recognition amount. So you will have to defer and amortize this amount over the period of loan. So loan is of 1, 2, 3, 4, 5 year. So 1,93,728 divided by 5 will be means every single year you will have to debit it into your profit and loss account. So like profit and loss account debit to prepaid staff cost account, which will be 1,93,728 divided by 5. So that much amount will be debited into your profit and loss account every year till the 5 year. So this is how it's gonna work. So this is the amortized cost. So this is the amortized cost of the loan, and the method like you are discounting, like you are calculating the interest at the rate of 10%. So this is the effective interest method. So this is the effective interest method, and this is the amortized cost. So if you want to also check out like the definition of amortized cost, so it's in the page number 50. So like amortized cost of fixed financial asset or financial liability. So the amount at which the financial asset or financial liability is measured at initial recognition minus the principal repayment plus or minus the cumulative amortization using the effective interest method. So this is the definition, and we have proved you that how its definition will work. Like you have to first calculate initial recognition. So initial recognition amount is like in our example 14,06,272 and like minus the principal repayment, and we have minus the principal repayment, like this is 4 lakh here, and then minus principal repayment plus the cumulative amortization using the effective interest method. So we have also add this 1,40,000 into this amount, so we have this amount, and that is called the amortized cost. So we have now seen that how the amortized cost method will work. And the principle, like you are using the effective interest method. So this is the effective interest method where you are charging the interest at the rate of 10% and then subtracting the repayment amount. So this is the effective interest method, so don't confuse it. This is the effective interest method and this is the amortized cost of the loan component. The link of this document which I have given you as an example is in the description of this video, so you can check it out so that you can also cross verify it. So now as you can see that the amortized cost is basically the present value of future cash flow which you will receive from the other person. So like if you have given a loan to some person and the interest rate you charge from that person is 5% and the actual interest rate is 10%. So now you have to first calculate the fair value for initial recognition and then calculate the amortized cost by using the effective interest method. So one thing which is very important is that the cash flows, future cash flow is very important to determine the amortized cost of the financial asset or financial liability. So now what about when there is a change in the cash flow, when there is a modification in the contract between you and the party and due to which the cash flow will be modified in the future. So now how will you do it? So paragraph number 5.4.3 talk about the modification of contractual cash flows, and it says that when the contractual cash flow of a financial asset are renegotiated or otherwise modified and the renegotiation or the modification doesn't result in the derecognition of that financial asset in accordance with this standard, an entity shall recalculate the gross carrying amount of the financial asset and shall recognize a gain or loss in the profit or loss. So now you have to recalculate the gross carrying amount of the financial asset, and whatever will be the modification gain or loss, you have to recognize this into your profit or loss. The gross carrying amount of the financial asset shall be recalculated as the present value of the renegotiated or modified contractual cash flow that are discounted at the financial asset's original effective interest rate. So now as you can see that you have to recalculate the gross carrying amount of the financial asset, and those will be the difference between what you have already recognized up till the modification and now what you have calculated now as per the modification term. So that will be modification gain or loss and that will be charged to profit or loss. And now how will you calculate the modified amortized cost? So you have to calculate the modified amortized cost by way of discounting the modified cash flow at the original effective interest rate. So that's how the modification will work. So now you have seen that how to calculate the amortized cost, and now the two category, which is the fair value through other comprehensive income and fair value through profit or loss. So as you can imagine by the word or name of the classification, which is fair value through other comprehensive income and fair value through profit or loss account. So fair value through, so it means that whatever will be the fair value and whatever will be the difference between the earlier recognized fair value and now recognized fair value will be charged either into profit or loss or other comprehensive income. So in case of fair value through other comprehensive income, you have to calculate the fair value at every single balance sheet date, and whatever will be the difference between the earlier fair value and now fair value will be charged to the other comprehensive income in case the category is fair value through other profit or loss, and in case the category will be other fair value through profit or loss, then whatever will be the difference between the fair value which you will calculate right now and the fair value which you have already calculated in the previous accounting period, those difference will be charged to the profit or loss. Simple, because the word itself suggests that fair value through profit or loss or fair value through other comprehensive income. So whatever will be the difference between the fair value, those will be charged either into the other comprehensive income or the profit or loss. So let me just give you an example of how the fair value through other comprehensive income will actually work. So here's an example of how to account for the fair value through other comprehensive income. So in this example, like Metallic Limited has made an investment in equity instrument of a company, Castor Limited, for 19% equity stake. Significant influence not exercised. the investment was made for rupees 5 lakh for 10,000 equity share on 1st April 2001. On 30th June 2001, the fair value per equity share is 45 rupees. The company has taken an irrevocable option to measure such investment at fair value through other comprehensive income. So as you can see, the company has acquired 19% equity stake and the significant influence not exercised. So what is the relevance of it? So because if you have the significant influence, that you have to account for your investment in equity as per the consolidated financial statement. So in our example, the significant influence is not exercised and you acquired it for 5 lakh and 10,000 equity shares. So it means that the price of one equity share is 50 rupees you can say, and now fair value has been changed to 45 rupees. Earlier it was 50 rupees, now fair value has been changed to 45 rupees, and you have elected the irrevocable option to measure such investment at fair value through other comprehensive income. So now how to account for it? So the company has made an irrevocable option to carry its investment at fair value through other comprehensive income. Accordingly, the investment shall be initially recognized at fair value, and all subsequent fair value gain or loss shall be accounted or recognized in other comprehensive income. So you know that at the initial recognition, every financial asset should be measured at fair value. So in our example, because we don't have any other data like how the fair value will be would be, so we will deem that this amount like 50 rupees is a fair value. So because you know that fair value in most of the cases is the transaction value, so transaction price or transaction value. So 5 lakh rupees is the fair value. So account for it upon initial recognition. Investment in equity share of C Limited to bank account, so that will be investment for the initial recognition. And then subsequently, because the fair value has been changed to 45 rupees, so you have to recognize the loss. So fair value loss on financial instrument account debit to investment in equity share of C Limited. So that 5 rupees losses, 5 into 10,000, so it will like 50,000. So that will be loss, and that will be account for into other comprehensive income. So like fair value reserve in other comprehensive income account debit to fair value loss on financial instrument 50,000 rupees. So that's how you have to account for it. Like for losses, you have to transfer that loss 50,000 rupees into other comprehensive income. So and at every single balance sheet date you have to calculate a fair value and recognize the gain or loss into other comprehensive income if that would be fair value through other comprehensive income. So now you have seen that how to calculate or how to account for the category fair value through other comprehensive income or fair value through profit or loss. But what about the dividend? So paragraph number 5.7.1a also discuss about the dividend. So it says like dividend are recognized in profit or loss only when the entity's right to receive payment of the dividend is established. It is probable that the economic benefit associated with the dividend will flow to the entity and the amount of the dividend can be measured reliably. So as you can see, those kind of a thing is exactly same as what was there in the accounting standard 9 revenue recognition. So because this Ind AS 109, the dividend or the investment in equity share will be now accounting will be done as per the Ind AS 109, and also its revenue from the investment in equity will also be accounted for as per Ind AS 109. So therefore the treatment of revenue from dividend is also given in this standard, which is 109. So similar treatment is there earlier in accounting standard 9. So nothing changed, just means the revenue recognition principle is now given in 109 account Ind AS 109. And what about the derecognition? So when you derecognize the category fair value through other comprehensive income, so how will you derecognize it and how will you account for it? So paragraph number 5.7.10 also says when the financial asset is derecognized, the cumulative gain or loss previously recognized in other comprehensive income is reclassified from equity to profit or loss as a reclassification adjustment. So now whenever you will derecognize the financial asset, then the cumulative gain or loss which you have previously recognized in other comprehensive income will be reclassified from equity to profit or loss as the reclassification adjustment, and also see Ind AS 1 for more detail. So now you have understood about the amortized cost, fair value through other comprehensive income, and fair value through profit or loss. And one more important point, so now you can see in case of an investment in equity share, you have the option to either classify it into fair value through other comprehensive income and fair value through profit or loss, which we have earlier discussed in our previous video. So when you held the equity share for trading, then you have to classify it into fair value through profit or loss, and when you held it for not for trading, then you have to classify it into the fair value through other comprehensive income. So fair value, so it means that you have to calculate the fair value at every single balance sheet date, even if that investment is for the long term. So that's how it's gonna work. You have to calculate the fair value at every single balance sheet date, and whatever will be the gain or loss, you have to recognize either in profit or loss or in the other comprehensive income, which will depend whether you have held it for trading or for other purpose. So for long term investment, you have to classify it as the fair value through other comprehensive income, and whatever will be the gain or loss will be charged to other comprehensive income. But paragraph number B5.2.3 also discuss about the application guide in respect of investment, and it says like all investment in equity instrument and contract on those instrument must be measured at fair value, and we have already know about it. However, in limited circumstances, cost may be an appropriate estimate of fair value. So it says like cost may be the appropriate estimate of fair value in some circumstances. So that may be the case if insufficient more recent information is available to measure the fair value, or if there is a wide range of possible fair value measurement and cost represent the best estimate of fair value within that range. And paragraph B5.2.4 also give you the indicator that cost might not be representative of fair value, and which include like A to G give you the indicator that cost might not be representative of fair value in those situations. And important paragraph is like paragraph number B5.2.6 also says like cost is never the best estimate of fair value for investment in quoted equity instrument. So paragraph number B5.2.6 clearly says in case you have the investment is quoted equity share, then cost cannot be the best evidence of the fair value. So in case of a quoted investment, you have to classify it as the fair value, and whatever will be the gain or loss will be charged into other comprehensive income. In case of a non-quoted investment, then those principles will be applied where it says like cost can be the fair value, but there is also indicator in which cost cannot be the fair value in case you invest in some equity share which don't have the quoted investment or which is not quoted into the share market. So that's how it's gonna work. You have understood the how to measure the financial asset or liability at initial recognition, at the fair value, and subsequent recognition. You have to classify, check out the classification. If that will be amortized cost, then first recognize the fair value by way of discounting at the market rate of interest, and then afterward you have to charge the profit or loss as per the amortized cost. Calculate the amortized cost using effective interest method. And in case of fair value through other comprehensive income, fair value through profit or loss, calculate the fair value at each balance sheet date, and then whatever will be the difference between the fair value of earlier period and fair value of this period, charge it into other comprehensive income or fair value or in the profit or loss. And we have also discussed like whenever there will be modification in the contractual cash flow, then how will you recalculate the gross carrying amount of the amortized cost. We have also discussed like when the investment in equity share you can take the cost as a fair value in case you don't have the investment in quoted equity share. And we have also discussed like dividend, how to account for the dividend. So that's how it's gonna work. Measurement is all about initial recognition and subsequent measurement. So I think you have clarified your doubt. In this category there is also impairment. So we will discuss about the impairment in our separate video. We will not going to discuss in this video because impairment is a, you can say, huge topic. So it will be very long video if we will discuss impairment also in this video. So alright guys, I think you have understood all this. If you have the query, then ask me on the comment section. I will reply it by way of a separate video, and the link of that document which from which I have shown you the example will also be given in the down in the description. You can check it out. So it's really free. Alright guys, so now we will meet again in my next video. Till then, bye bye.